All right, folks. Welcome to our Air Miners event on contracting with our sponsor, Wilson Sonsini, Goodrich, and Rosati. So it's a pleasure to see you all here today. I'm Jason Grillo with Air Miners. Glad to have you join us today. Glad to be on the journey with you on our mission to remove the first 1 billion tons of carbon and its equivalent from the atmosphere by the end of 2030. That's the goal we have ahead of us in Air Miners. That's what we are embarking on. And to that end, we're working on understanding carbon markets and how they work. Because the field is so new, the idea of how to contract for carbon credits is very much a black box. What we want to do today is unpack that with two esteemed partners from the firm Wilson Sonsini, Goodrich, and Rosati, who have, as I mentioned earlier, generally sponsored our event today. So thank you so very much. A little bit about logistics. Yes, we are recording this. Yes, it will be on our YouTube channel later. What we are also going to do is have Elise and Manya walk through a short presentation, and then they'll be available to take your questions. So when that time comes, please use the Zoom function to raise your hand, and then I'll call on you in sequence to ask your question of Manya and Elise, and we will go from there through to the end of the top of the hour. At that point, I'll stop the recording, and then we'll have our traditional post-event networking where we can kind of get to know each other a little bit better in Zoom breakout rooms rather than know of each other. That way, we'll have a more in tune community. So to that end, feel free to stay for that networking at the tail end, but again, we're all busy, so don't feel obligated. Without any further ado, thank you, Elise and Manya, and I will cede the floor to you all. Thanks so much.
Thank you, Jason. My name is Manya Sachet. I'm a partner in the Technology Transactions Practice Group at Wilson Sonsini in the Seattle office. I work closely with our energy and climate solutions practice, including Elise, on direct air capture technologies and clients, business models, and a variety of other technologies in the sustainability space writ large. I've been working at Wilson Sonsini for about 17 years and have engaged in all kinds of commercial contracting and intellectual property related matters. Elise?
Thanks, Manya. So it's really an honor to be here today. My name is Elise. I've worked in sustainability for 25 years. I co-lead our climate solutions practice. And what we're really hoping to do today is spend 30 to 45 minutes to leave enough time for questions, to give you a good checklist for and to explore some of the key ways of thinking about one of your most important assets, which is this carbon that you've either captured, sequestered, or otherwise removed. So we're really hopeful that you will interrupt us often, and Jason is going to be our master of ceremonies there so that you're getting to ask questions in real time. I want to say that we will not get a chance to answer everyone's questions, but we really are hoping that we'll get a chance to answer the key questions so that you walk away feeling like you understand how to proceed with these fundamental contracts that are part of your business. So Jason, to your mind, starting with our presentation. Can everybody see this now?
Yes, thank you.
Awesome. Jason, will you go back for me just one slide, please? Yep, now forward one. So in terms of content, folks, this is just a snapshot. It's from WRI. It has spelling errors in it, so we apologize for that. But the reason we wanted to put it up on screen is because it's one of the premises of what we're going to talk about today. And that is it's very early days for DAC projects and therefore the contracts related to CO2. Early days is not a bad thing, But the thing about early days is it means that contracts will tend to rapidly evolve. And so we're going to try and capture some of the ways to think about your contracts and to write your contracts so that you account for this rapidly evolving space. Next slide, please. So this is a leading general counsel's thinking about the importance of good contracting. And the bottom line here, which I think is incredibly important for all of you, is that contracting isn't an esoteric exercise. It's a way of providing market stability and therefore revenue stability for all participants in the space. So we've listed Catherine's point of view because she's a good thinker in the space. And we agree with her that if we get standardization, we're going to get a more certain market environment. Next page, please. So when you're in a new market, you get to think about different models. And we worked really hard to think through what some of the models are, including in our own contracting. We're not going to spend much time here, but we wanted you to have these possibilities for the models and where you can get good ideas and good language that's relevant to what you're trying to do. And we'll let you know that for the model we're going to talk through today, a lot of the examples come from the offset models, and in particular, the regenerative farming and afforestation contracts, which have been out in front in some of the markets that we deal with. Next slide, please. Manya, do you mind jumping in?
So, at a very high level, the goals of any contract are, we've captured some of them here, some of the most important ones, and we think the ones to really focus on for your purposes in this early stage in the market are to use your contracts as a way to ensure that you have a shared understanding with your buyers if you're a seller. And establish expectations with one another around how you're going to behave in certain circumstances and in relationship to one another. You want your contracts to demonstrate that there's revenue certainty for your company and that your company has liquidity, and in turn that your company is financeable, and that these contract rights underpin that activity. So you want to make sure that your contracts are as solid as possible to demonstrate to prospective financiers that they should have confidence in your company and what they can expect from your company. And the last point obviously is related to that about marketability. You really want your contracts to be easily understood and clear on the revenue implications of the contract, so that you can market your carbon credits and have certainty around the marketability of what you're doing.
And I think it's important to say, Manya captures it beautifully. I think it's important to say that this slide is progressive. So if you're financing, you're going to have a higher contracting standard than if you're not. If you're securitizing, which is where we would hope the market gets to, you're going to have a higher standard of contracting than if you're just doing bilateral agreements. That doesn't mean bilateral agreements aren't important, but it does mean, and it'll allow you to look at models and recognize sort of where they are in the market and get yourself a good model. Next slide, please. So if you're in an early contract dynamic, the thing that these are each of the tension points that we want to make sure you're comfortable with. And Manya and I will probably go back and forth on a couple of these because the decisions are going to be quite specific. You're going to have a reason for making a decision, but we want you to have the context for making a decision. So the more uncertain the market is, usually the shorter the term of the contract. That's really hard here because the contracts tend to be structured as long-term contracts. So think about that balance, and you can always come back to us and talk about what should we do under a specific circumstance. If you're going to have a long-term contract, which is okay, you should have reopeners. And the reopeners will make sure that you don't get caught in a contract that has long-term pricing or other considerations that don't evolve with the market as it grows. Reopeners are also great for changing regulatory mandates, and we expect a bunch of those here, and we can talk about those at the end. But it's really important to capture the opportunity to revise your contract based on changing legal rules. For me, the reason to have a shorter term or to have a longer term with reopeners is cost. So a lot of these contracts are essentially hedges or arbitraging contracts at this time. And if the market changes, that means you can get underwater, and you're going to see later on, we talking about how there's often a cover obligation in the contract or an obligation to go out and make the buyer whole if you have a shortfall in your delivery obligations. With changing costs, that can be a double-edged sword, and we want to make sure that you have good functional language to manage that. The last three are on here because we tend to see intermediary fees not be understood and be very high for early companies. And we want just that to be a red flag for you all, that your intermediary fees should be at a reasonable percentage of the contract or should be shared benefits. The credit risk is similarly really hard for early stage ventures or even later stage ventures. And it's too general a topic. We could spend an hour talking only about that, but we are happy to spend some time at the end talking about creative ways to manage credit risk obligations. And then disputes. Nobody goes in thinking about that a dispute will result, but it's important in new markets to make sure there's somebody you can turn to that knows enough to be able to oversee any disputes in what I would call an efficient and positive way. And so there's a special dispute consideration here. So these are routine considerations for all early contracts in all early markets. If you went to any group of lawyers, they would say these are things to think about. It's also a checklist for you all. If you haven't thought about each of these substantively, now is a really good time. Jason, do you mind the next slide? So we talked generally about contracts. Now we're going to talk about carbon contracts, any form of carbon contracts. I think I'll take the first two, and then Manya and we'll pitch in on the last three, and then we'll go to some examples in a couple of seconds. But the one thing that I think that we can't emphasize enough is knowing what you're selling and the quantities of what you're selling and the estimation uncertainties around them. There is nothing wrong with uncertainty, and there is nothing wrong with, especially for early stage efforts, uncertainty around volumes. But I think if Manya and I sat in a room and went over all of our contracts, the problems that we've experienced most is when folks had not decided what they were selling, for how long, how much, and subject to what correction factors or uncertainty analyses. And those tend to be the most disruptive of the relationships because people literally don't agree on what is delivered on a monthly, quarterly, semi-annually, or annual basis, don't agree what its value is, and don't agree how to address uncertainties or shortfalls. Our carbon forwards securities. So this is a great question. It's a question that is going to be determined in the United States through a regulatory process that is ongoing. But I think there is a widely held view that carbon credits function as forward contracts and are likely to be regulated with some exceptions as forward contracts. Is that helpful? And we're going to focus on the United States here. I'm always happy to talk about Europe and Asia. Yes, that's one of the regulators, but not the only regulator. And they're undergoing, just to be clear, the question was, you know, who is the regulator?
Yeah, and the answer was the CFTC.
Yeah. And the CFTC, I'm going to strongly encourage folks, if you haven't listened to this 5-hour CFTC open session on the treatment of carbon contracts, it's worth doing or having someone on your team do, in part because you get to really hear what people perceive as the risk around these contracts, the uncertainties around the contracts, and the fraud concern, all of which are real. So Manya, I apologize because I muscled into your forward sales discussion, but do you want to jump in?
Oh, sure. So for forward sales, you need to determine a price, and you'll have to consider, you know, how are you going to calculate that price? Are you discounting the present value of 20 years, or are you creating an annual obligation? Are you accommodating in some way for a price change year over year? There are a variety of ways to think about this, and you know, I don't know, Elise, if you have a specific perspective on what you've seen, your experience works better, but people might want to hear about that.
Yeah, I think that discounted present value over 20+ years is a really tough way to go. That doesn't mean it might not be right for some entities in some contexts. There's a question, have I seen committed prices float? Yes, and I write those all the time. How can the purchaser be protected? We have another question. How can the purchaser be protected against the... Jason, could you finish that? Because it disappeared.
Sure, the risk of reversal, for example, as a result of natural disasters.
So there's a number of great ways to prevent against shortfalls. And ordinarily it's to sell a fraction of the annual production at price X, and then with the remainder to arbitrage it or to sell it at a slightly different rate, often at a premium. So that way you're obligated on a certain percentage, but not obligated for 100%. And then you annually, there's an averaging process and also a force majeure clause for catastrophes. Does that help?
So I think Elise, you just hit on the netting overproduction and shortfalls point there. And in terms of delivery, the question is, what is physically settled and why should I care? And the reason to care about that language and why it should be used in your contracts is to ensure that that you're signaling to the reader of the contract that you intend for this contract to fall outside, to fall within the forward contract exclusion from the swap definition. And so physical settlement is you can think about it in terms of the physical removal or the physical reduction of carbon, and that is delivered in the form of a certification that you've done that removal.
So somebody asked if there was a mechanism for escalating or for altering price. And I will tell you that I have no fewer than a dozen. They're ordinarily very specific and they relate precisely to the uncertainty and risk and the projects being evaluated. So I have not seen, I mean, I've got a number that relate to exchange prices. I've got a number that are addressed vis-a-vis expectations of the parties and are adjusted based on monitoring over the first 3 years. But I have not seen a standard form that applies to everybody, if that's helpful, in part because the market is so differentiated. So if you go to the next slide, I think we'll get to verification and some examples. Maybe the right thing to do is to move to the examples because I think they'll help folks to look at specific language. Yeah. So this is actually language from real contracts. And I wanted you all to see, these are all contracts that have come across my desk or I've seen or worked on. And they really show how far ranging the definition of what you're selling is, which everybody's selling essentially the same thing. So the first one, we're going to go over what an attribute was at the end, but you can see that this was a quite ambiguous definition, right? Very broad. And that can be appropriate in some circumstances, but the or similar instruments is a really tough sell to understand. The second one is a verification standard. We're going to talk about that. This one was a verification that has been recognized by the council. The council wasn't defined. I asked who the council was and nobody can answer the question. They had clearly taken a document and a model, and they knew they had verification, but they hadn't got to what verification meant. And we're going to talk about why that's important. The last, internationally recognized, that can be a perfect standard, but it's an ambiguous standard here, right? And this one has biodiversity credits, which I do a lot of and I'm really supportive of, but they didn't actually do biodiversity credits. I think these are really important in understanding, and the yellow is meant to identify. There is nothing wrong with any of this language, but it's really important this language actually reflects what you're doing. So if you go to the next page, I think we're getting closer with these two definitions. And the difference between them, which I think is really valuable, is understanding if you're providing a deliverable instrument and understanding if you're including tax benefits or otherwise. From my perspective, it doesn't have to be longer, but it has to correspond to what you think you're doing. And I think these were circumstances in which they were manuscripted by teams that really had a great sense of what they were selling and what they wanted to be ground truthed against. So Jason, if you wouldn't mind going to the next page, I want to go back to that definition of environmental attribute. This one was a very particular definition. It happened to be related to electrons, but it was very particular. So it was the wrong definition wrapped into the wrong contract, as you saw it on the first page we discussed. But it was very particular in saying, but not these rights, including here, not water rights, and of separating out some of the renewable energy programmatic rights. And I think that in many ways, this is a really helpful kind of definition, because it wants to be clear that we're getting a lot of stuff, but we're not getting some specific things. And the only standard for being an attribute is that it is capable of being measured, verified, or calculated. So again, very broad. Now you've transferred a lot. If you only meant to transfer carbon credits and not biodiversity credits or other things, this would be the wrong definition. But if you meant to transfer this stuff, it would be a good definition and for an attribute. You would go to the next slide. Here's where we get to some annual contract volumes, shortfalls, minimum volumes. And I believe this goes to a series of questions that folks had. So this is good baseline language, right? All of the devil's going to be in the details. But you can see that here the seller is responsible for covering any shortfall in an annual contract volume. And the way that they have to be covered is either through a monetary payment or a carbon emissions offset equivalence. This is very general language, but I think it's quite useful in terms of seeing this is reasonably representative of a lot that's out there, and then all of the hard work is done in the definitions. And the annual contract volume can actually be a schedule at the back that changes every year, is subject to readjustment, as one person asked. And then the shortfall can relate to a minimum volume, even though the estimate is above the minimum volume. So I would say most sellers don't like to agree to cover shortfalls. In most instances, they do not have the capacity to cover the shortfalls. The market is nascent, and a lot of times you're dealing with market leaders. If you need to, if you're a seller that's being asked for to cover a shortfall, my view in most instances is you're negotiating the wrong deliverable. So I would roll back on the 100%. So Claire asks, what happens if your verification does not true up? And to my mind, that means that you have sold too much forward, or the uncertainty factor around what you were selling is not clear. And I'm going to apologize in advance. Everybody who knows me knows I'm a mathematical being. It's really important to get the math right here, right? The uncertainties can be significant, and we have to define them accurately, and we have to explain why these uncertainties exist. And then we have to have a process for reducing the uncertainty over time in the contract. Claire, does that answer your question?
Yes, thank you.
You're welcome. It's a really important question. So let me give you an example. You have 100,000 acres of trees, and your sample is based on the selection of 5 trees. It is virtually impossible to subset 5 trees on a verification basis and get within the uncertainty values in the following years. So there has to be a monitoring system that has a baseline set reasonably, and that has a measuring system that can accurately surmount the uncertainty values that are intrinsic in all of this. There's no downside there. It's about having a candid conversation about what uncertainty is and having a period of time to be able to work it through. And I would say, and I'd love if I could see you all and you could raise your hands, but I would say that most of you would agree that in the first 5 years, you can't provide a cover. But after year 5, you may have, from years 5 to 10, you may have sufficient information, depending on what sort of carbon credits or offsets you are transacting in, to be able to surmount uncertainty, to be able to provide cover later. Yes, we skipped that slide because I wanted to get to the specific language, because we had a number of requests for, how do you address volumes, estimates, and true ups? And there were actually too many questions to ignore it. So we jumped ahead, but all of my contracts, and you'll see them on the street, address the critical factors with respect to carbon credits, double counting, permanence, additionality, and verification. How many credit types are there at the moment is the question. There, depending on what folks are focused on, there can be a significant number of non-carbon credits. So I see and work in biodiversity credits. There are cultural stabilization credits in some places. There are landscape and aesthetic places, and in many instances, nations or states looking to preserve important cultural values will set standards for credits that are backed by states that can be sold in addition. What bothers me is when people think they're selling only carbon credits, but they sell everything in a way that means that they no longer have an ownership interest in residual credits that may have significant monetary value in the future. And I want to say, regrettably, I see that too often, where I say, do you believe yourselves to be selling all future attributes, or do you believe yourself to be selling carbon credits? And I often get carbon credits when the writing is all future attributes. That's why we put that first. I want to have you all as a group thinking about that. So I think we should go to the next slide because we're getting late. So verification is really important. This was a situation in which a buyer had an opt-in right to verify. But any shortfall in the verification was deemed to be a failure to meet the contract minimum, and the costs of the verification, if it identified a significant failure gap, were paid by the seller. If you Googled this contract, you would see it. So I'm going to tell you, this is a publicly available contract. It's not a contract that I suggest is a good one for a seller. I can't, we've got a question about the deck. I think we're going to work through a system to making the deck available to folks. But so we will come back to you with how that works. So then certification, this one is actually makes me smile because I really understand. I'm going to stop for a second because I have the buy side and the sell side. We represent both. But we are, if folks don't know us, I apologize. We want to get to the meat of things, but we are, our work and the key aspect of our work is working for new enterprises in new markets. That's what we do. That's what I've done for 25 years in the sustainability space. And so we tend to represent those who are pioneers in the space and therefore sellers. But we've done both sides. So going back to certification, certification is an absolutely reasonable thing to request. And the question is, how much time, money, and effort are you going to spend trying to get certified? And certification is very much like verification. Again, I wish I could see a show of hands, but I think if I could ask you and you all would turn on your videos and I could see you all arrayed, you would say that you receive a higher carbon price for verified, double verified, and certified carbon. And so again, there is every reason and incentive to do this. It correlates to price. The question is what you're going to commit to do. And here I substituted in commercially reasonable efforts over best efforts to certify. And then this contract had a clause that said any failure to timely obtain certification is treated as a deficit on the contract year volume mandate. So I want to be really clear what that did. That said, that means you had to cover it. And I think that deficits are failure to certify should not be treated as a volumetric deficit for sellers. Jason, could you read that last comment to me? I was speaking and I didn't get a chance to see it come up.
Sure. You mean the one from Rob Godfrey or the one from Bard?
I think either is probably the right.
So Rob Godfrey asked, would you advise selling on a unit contingent basis? Buyers will want a firm number, but preferable for our sellers to provide an estimated number, but promise a proportion of verified quantity or similar.
Yes, that's the way I ordinarily manage it is here's what we estimate. Here is our commitment volume. And above our commitment volume, we're willing to sell that to you. But that is done on slightly different terms and with no obligation. And I can't tell you mathematically what the percentages should be unless I know more. All right, so I think we should go to the next page. So this is also common phrasing. Audits are right to audit your carbon credit measurements independently. The 2-year time frame, I'm not sure is market. For some of these contracts, I tend to see longer periods, but what I think is really important about this is most business people think of audit rights as books and records rights, and it's less common for it to be about your carbon credit measurement systems. So this is a good flag. You can be very comfortable about this, but I would agree on the ground rules for the audits. Because otherwise measurement differentiation would not be surprising. So could we go to the next page? I'm gonna flip this to Vanya because I just think this is a baseline and we did it as a checklist for you all so that you knew that you should have all of these in your contract.
So thank you, Elise. This is not an exhaustive list, but these are some of the key considerations that you'll want to make sure you cover in your contracts. The recitals clause, you could see it as a formality at the beginning of a contract, but what it really does is it provides an opportunity for you and your counterparty to explain what you're doing and to help a reader in the future understand what your intent is. And the reason that could be important is not only that, if these contracts are long-lived, there will be other people who are reading them in the future and interpreting them, and having guideposts to help understand what you originally intended is pretty key, especially in situations where there might be an ambiguity in contract language or some vagueness. And in addition, intent is important in the forward contract context, whether or not the parties intended for there to be physical settlement is relevant. So I'll leave that there. You'll want to include specific terms about how payment is structured and how delivery, how the parties are going to deliver on their obligations, in particular, how you're going to deliver the credits. You'll want to discuss specifically what happens in a default context, and what are the consequences and what are the remedies for each party in an event of default. This is really important because, you know, there may come a time when the the credit that you're selling could be obtained on the market for less money by the buyer, and so they might not be incented to make the, you know, to meet their commitment to purchase from you when the time comes. And so you'll want to think about that and how do you define what happens in that circumstance. There, in any contract, you'll have risk allocation that you want to address, which party is going to bear which kind of risks. You want to think about what kinds of limitations of liability are appropriate, whether indemnification in any circumstance is appropriate of the buyer. You know, we assume we're talking mostly to sellers here, but you know, would there be a situation in which you should indemnify the buyer from third-party claims arising out of the activities under this contract? Just a note, you can't limit your liability for fraud. So even if you include a very nice limitation of liability for yourselves, if for whatever reason you haven't been clear in the contract about what you're doing, or if you behave fraudulently, you're not going to limit your liability for that. You'll want to address termination. Can either party terminate? Under what circumstances can you terminate? Dispute resolution provisions. This goes back to something that Elise mentioned earlier. You'll want to make sure there is a clear pathway for resolving differences and not just leave it to suing one another. Preferably, there would be some sort of dispute escalation clause where the parties try to reasonably discuss. And if you do get to the point where you need to have an intermediary help you with that dispute, you'll want to think about what the qualifications of that intermediary are. You know, does that person have a certain kind of expertise, and do you agree on who that person or who those people are, especially in an arbitration context? Force majeure clauses, very important for companies who are doing things in the physical world. And you know, do you define force majeure as a seller very broadly as all kinds of things that could disrupt your ability to produce the carbon credits, and the pressure is of course going to be from the buyer to limit those that definition of force majeure, and you know, try to ensure that you deliver. Choice of law, you know, that as a general matter, usually parties try to choose law that is the jurisdiction where one of them is located, or where the project is located, but it doesn't have to be that necessarily, and that will vary from case to case. Elise, is there something specific that you wanted to say about choice of law?
Yeah, so let's talk about, we've had a number of questions about who the right arbitrators are. And I do think that in most cases, arbitration is going to be preferable in these circumstances to litigation, in part because I think it's going to be really important to be able to find a knowledgeable party, as I mentioned previously. But you can't say, and someone asked me, is JAMS the best? And the best is defined by where you are and what the applicable law is and rules are. And that is, you are welcome to call me separately, but that is an actual and real question that you can't answer by saying one entity not knowing the facts. So
thank you.
And in terms of choice of law, I think this is a really important question. We routinely see choices of law that are where the product is, and that's okay. if you are a seller and you are located there, that can be useful. I've had a number of circumstances in which it's not the right choice of law. And that project can be, I have projects in Africa and the Americas, in Asia, in various places in the United States. So the commercial choice of law is the default commercial choice of law is Delaware, New York for the United States. California is a close third. Those are reasonable commercial choices of law, and they're reasonable defaults, but you should look at your own specific circumstance and ask yourself, why are we choosing this? And if it's one of the defaults, you can feel comfortable on those contracts. The choice of forum I routinely see is absent, and folks get notices to appear in places, and they, as I mentioned here, I didn't realize we have to fly to London. And so if you're choosing a legal, a choice of law, if you're making a choice about what law should apply, it ordinarily should be that you're willing to litigate in that place where the law is the expertise. Delaware, you can move other places that are commercial centers, and to a lesser degree, that's true in New York. But think about those as paired and think about where you're going. If you choose arbitration, which would be my default, then you should pick a consensus location for the arbitration, one that's reasonable and reduces costs. I want to emphasize what Manya said. She captured it beautifully on the recitals clause. If you have a recitals clause that says, because the parties want to collaborate and each bring complementary skills, they enter into the following agreements, that is not enough for these contracts. And I just want to be clear, don't do that. And the reason you shouldn't do that is because if you have a reopener clause, you cannot put the contract back to a reasonable mechanism for the party's intent unless you state what the party's intent is. And leaning into the intent to describe and to clarify that this is a rapidly evolving market, I find has been the best way for companies to be able to preserve their later ability to reform contracts as law, facts, and market price change. So I think we should get to our last slide because we want to be able to open it up, and I bet I can do this slide in a minute. I'm not kidding about any of this. We're here because we believe that this entire sector rises if the contracts are more commercial. Just exactly as Catherine said for ISDA. So a contract is not a legal act. It is how you communicate. And it's really important that you communicate effectively. If you don't understand your contract, something is wrong. If you don't know how it works, something is wrong. There's nothing magic about what Manya and I do. We're good at math and we can read. That means that it's really important that you think of yourself as engaged in a living effort to be able to set the market for your assets, which we think is important. Make sure we do it well. Make sure that you have an engaged discussion with your counsel, and particularly if you're receiving a form, mind the fine print. So I think we should, if you all don't mind, get rid of the PowerPoint, start to see you all and let you come off mute. And we're going to hope this isn't going to be too much of a cattle call, but take some functional questions.
Got about 5 minutes, so raise your hand and we'll go from there. We'll try to get to everything, but I've also shared Elise's and Manya's emails in the Zoom chat. So Emily Howgood.
Hey, Emily.
Good to see you again.
Hi. So really quick question about the length of these contracts. I know you said contract duration at the beginning. Looking at a carbon storage contract and how long carbon storage needs to last to be permanent, so like hundreds, thousands of years beyond, how do you recommend addressing that?
Yeah, so that's a really great question. For transacting carbon, kind of the swaps side of the equation, I think that 20 years is considered the norm. For the sequestration projects, and I want to say permanence is ordinarily considered to be 100 years is defined as permanence for many, but I would say 20 years is the commercial norm. On the sequestration side, I think some of the best models for you, Emily, are going to look like some of the nuclear models, and particularly ISFACs, where you design for permanence, but you know that permanence is not a commercial concept. And if you call me separately, we can talk about how we do that.
Thanks so much.
It's absolutely nothing. Nicole, it looks like you have a question.
Sure. Hi, thank you so much for the presentation. Working in an investment company, and we do make loans to carbon projects, and sometimes we use carbon credits as a security in the loan. And I just wanted your feedback. Have you seen future issuances of carbon credits used as security in loans before, or in financing, or even in a streaming agreement or forward contract?
Yes, and yes.
Okay, and if so, do you have any recommendations on language, and also, you know, how that security is actually treated in terms of how you get access to it or gain control of it in the in the event of a default, or if you needed to?
So this is an absolutely brilliant question. I want to just underscore for folks that what a carbon credit is varies in different nations and in different states, and whether it is a real property interest or an intangible interest or a tangible interest determines what you have to do to make it a security interest, and how hard it is, and what your uncertainties around it are. So
and does the jurisdiction depend on the country of issuance or the country of the domain of the contract?
So it is almost always going to be the issuing country is relevant, because your ability to execute on, if you think about where the project is, it generates the contract. And so if you don't have a legal right in that location, that can be a real challenge then.
Okay.
We could talk about this for an hour and a half. Manya and I spent a lot of time talking and thinking about this. What I would say is it's really important that you have a flexible contract term that says the parties intend for ownership to transfer in the following ways. And the contract will be reformed to ensure that the parties can do that at the time of default. And so start to think about it like traditional financing arrangements, where you end up making sure that the parties sign the right agreements to deliver the right legal rights to the credits or the offsets at the right time in the right way. Does that help?
Yeah, it starts to help. Thanks a lot. Lots of more questions, obviously.
I'm sure, but I think that what you want to get away from is thinking it's a static statement that would apply all over, and that will do it for you. What you really want to do is have a process for getting those credits to you in the right time, in the right way. And that's actually easier to draft, and it's more secure. Cooper, I believe you have a question.
Sure, just kind of looking for general thoughts, nothing super specific. But looking from, you deal with the buy side and the sell side, looking from kind of the buyer's side, how are you seeing durability requirements kind of changing as we go forward here? Have you seen any shifts in that? And then, what kind of discounts are you seeing maybe at various TRL levels on the sell side, with or without MRB? It's a bit Kickstarter-y out there at times on the pricing, but are you seeing any kind of trends emerging in either one of those?
Yeah, I tend to deal with TRL 5+ most of the time. I mean, I've done, 2 women and their golden retriever in a lab. I don't want to suggest otherwise, but the point of commercialization is TRL 5+. So on the investment side, where the entity, the investor, is obtaining carbon credits, there's a pretty significant discount because there's the investor discount. where you're really talking about trading the carbon credits as an output, I have not seen a technology readiness level discount implicit.
Yeah, okay.
I have seen durability assurances, which tend to get bundled into the discussion around legal quality of the credit, what the certification is, and also permanence. So
Yeah, and are you seeing any kind of like trends in how those contracts are written for durability or permanence?
I've seen a lot of writing around permanence. I think permanence is the really, and particularly for Emily's structure, permanence is the ball game. And we tend to have very clear specifications around permanence and how permanence may evolve. And I think that's on the pore space side. I think that's incredibly important, and pore space holding side. I think that's incredibly important and should be done. On the carbon credits going into the pore space and the security of the sequestration as a services contract, I think we're very early days there, and there are some really bad models that have made it to the street and you know, I don't mean that unkindly, but I mean that people didn't
It's
really,
evolving.
yeah, it was rapidly evolving and people didn't really understand. And I've seen contracts with no mechanism for monitoring and measurement.
Yeah,
So
interesting.
there, I believe that the in situ, those contracts that have in situ monitoring wells are getting
Yeah.
a higher value.
Okay. Yeah,
than
interesting.
those-
I work in the in situ mineralization space, so that's kind of where the questions are rooted in.
It's a really good question. And again, I'm going to make a general, I don't mean general to the point of being unuseful, but I mean a general suggestion that you should agree on a process and 5 and 10 year reconsiderations of the process. For me, that is the mathematically, technically appropriate way of
Mhm.
structuring those agreements. And that's the way we manage things in other areas where there's, you know, not uncertainties, but where there's a lack of monitoring data, so that you don't
Yeah.
get penalized. And then we would link the dollars to the added increments of certainty.
Gotcha. Okay. No, thank you.
Yeah,
Great.
just like availability and capability hours. Think about
Yeah.
it, those, you know, I would take a really hard look at early solar versus today's solar agreements. I think you'll find really good models for getting to availability
Gotcha.
that I think are ideally suited to this space.
Okay. Very cool. Thank you.
Absolutely.
Thanks. That's all the time we have for questions for now, but I've shared once again the emails for Elise and Manya. Thank you so much for your time today. Just for the purpose of people who are maybe watching this in a recording, I'm going to share my screen one last time so that you can get Manya and Elise's emails in the video. There you go. Msachet, MSACHET at WSGR.com and EZOLI at WSGR.com. There you go. So it's now spared in video, recorded in video for perpetuity.
And I want to just say thank you for all of the fabulous, fabulous questions.
Thank you, everyone.
Yep, and that concludes the main part of our session. So I posted a link to our post-event survey, so let us know how we did, what we can do better, how that, and what feedback you have will inform future events. Also, our next event is going to be entrepreneur networking, network with other entrepreneurs in the air miner space. So share the link to that as well. Looking forward to seeing you at our next events. And until then, I wish you well in removing that first billion ton of carbon. Thanks, everyone.